The market does not hide its truth. It hides it from impatient men. Most traders are searching for the perfect indicator. They open their charts. They add moving averages. They add RSI. They add MACDI. They add Bollinger Bands. Then they add 5 more indicators to confirm the first 5. And after all that, they still lose. Not because the market was too difficult. Not because the indicators were completely useless, but because they were watching the wrong things. The real indicators that matter are not always found at the bottom of your chart. They are not always colored red and green. They do not always flash buy or sell signals. The only 3 hidden indicators that truly matter are much deeper. They are price behavior, volume, and participation, and the trader's own emotional reaction. Master these 3 and the market begins to speak a different language. Ignore them and no indicator in the world can save you. I learned this lesson the hard way. Like most men who enter the market, I once believed that success was hidden inside a secret tool, a perfect formula, a magic line, some rare signal that only professionals knew. I wanted the market to become simple. I wanted it to tell me exactly when to buy and exactly when to sell. But the market never rewards laziness. It rewards observation. It rewards patience. It rewards the man who can look at the same chart everyone else is looking at and see what they are too emotional to notice. Most traders want signals. The great trader studies behavior. That is the difference. A signal tells you what might happen. Behavior tells you what is already happening. And when you understand what is already happening, you stop guessing. You stop chasing. You stop begging the market for money. You begin to follow the footprints. The first hidden indicator that really matters is price behavior. Not just price. Price behavior. There is a difference. Any fool can see that price went up. Any beginner can see that price went down. But the professional asks deeper questions. How did price move? Was the movement strong or weak? Was it clean or struggling? Did price break a level with power or did it hesitate and return immediately? Did buyers push with conviction or did they panic after one small pullback? Price is the market's language, but behavior is the market's tone of voice. Think of it like this. If a man tells you, "I am confident," but his voice shakes, his behavior tells you more than his words. The market is the same. A candle can close bullish, but how did it close? Did it close near the high? Did it reject lower prices? Did it come after a long battle at support or did it only rise because shorts were trapped for a moment? Most traders only see candles. The trained trader sees intention. Price behavior shows you whether buyers are in control, whether sellers are weakening, whether a breakout is real, or whether the market is setting a trap. This is why support and resistance are not just lines. They are memory zones. They are places where fear and greed met before. They are areas where people made money, lost money, entered too early, exited too late, and promised themselves they would never make the same mistake again. When price returns to those zones, emotions return with it. That is why price reacts. A beginner sees a horizontal line. A professional sees trapped traders. A beginner sees resistance. A professional sees supply, hesitation, and memory. A beginner sees support. A professional sees defense, accumulation, and pressure. This is the first hidden truth. The market does not move because of lines. It moves because of decisions, and price behavior reveals those decisions. Imagine a stock has been falling for days. Every bounce gets sold. Every green candle fails. New traders start saying, "It has fallen too much. It must go up now." But the market does not care what looks cheap. A falling price can become cheaper. Then one day price approaches a previous support level. Most traders immediately buy. They say this is support. But the wise trader waits. He watches. Does price reject the level strongly? Do sellers fail to push lower? Do buyers step in with urgency? Does the next candle continue upward? Or does price sit there weakly like a tired man leaning against a wall? That moment matters. Support without strength is not support. Resistance without rejection is not resistance. The level is not the signal. The behavior around the level is the signal. This is where most traders fail. They trade the idea. The professional trades the evidence. You cannot make money by saying this should hold. You make money by observing this is holding. There is a world of difference between those two statements. One is opinion, the other is observation, and in trading opinions are expensive. Observation is priceless. The second hidden indicator that really matters is volume and participation. Price tells you what happened. Volume tells you how much interest stood behind it. Without participation, price movement can be weak. It can be false. It can be temporary. It can be a trap. Volume is not magical. It does not predict the future by itself. But volume gives weight to price. It tells you whether the move has support from serious players or whether it is just noise created by short-term emotion. When price rises on strong volume, it tells you buyers are not just watching, they are acting. When price breaks resistance on weak volume, be careful. A breakout without participation is like a speech without belief. It may sound impressive for a moment, but it often fails when pressure arrives in the market. Convict leaves footprints. Volume is one of those footprints. But again, do not use volume like a robot. Use it like a detective. Ask questions. Is volume increasing during the trend? Is volume drying up during the pullback? Are buyers active when price returns to support? Are sellers aggressive when price reaches resistance? Is the market moving with interest or is it drifting with no commitment? The best traders are not looking for one candle. They are looking for agreement. Price and volume must agree. If price moves up and volume supports it, the move has strength. Price moves up but volume disappears, the move may be tired. If price falls hard but volume is low, sellers may not be fully committed. If price falls into support with high volume but cannot break lower, something important may be happening. Maybe strong hands are absorbing the selling. Maybe weak traders are panicking out. Maybe the market is changing ownership. This is what the ordinary traders never sees. He sees fear. The professional sees transfer. He sees supply being absorbed. He sees panic being bought. He sees the crowd losing patience while stronger hands quietly take position. Markets often turn when the crowd gives up. But they do not announce the turn with a bell. They reveal it through behavior. Price stops going down. Volume increases. Bad news no longer pushes the market lower. Sellers attack but price refuses to break. That refusal is information. The market is saying something has changed. Most traders are too emotional to hear it. They are still thinking about the last loss. They are still angry. They are still scared. They are still waiting for certainty. But by the time certainty arrives, opportunity is often gone. Trading is not about certainty. It is about probability, and Valium helps judge probability. Let me give you a simple example. A stock has been moving sideways for weeks. Resistance is clear. Every time price reaches that level, sellers appear. Most traders see the level and immediately short. But one day, price approaches resistance differently. It rises steadily. Pullbacks are shallow. Volume begins increasing. Candles close near their highs. The market is no longer weak at resistance. It is pressing against it. It is testing the wall. Then price breaks above resistance with strong volume. This is not just a line being crossed. This is pressure being released. This is trapped sellers being forced to cover. This is breakout buyers entering. This is momentum waking up. The beginner says it is too high now. The professional says the market just proved strength. That is the difference. Most traders want to buy low. Professional souls want to buy strength at the right moment. A weak market can always become weaker. A strong market can continue far longer than the crowd believes. This is why Livermore understood the importance of being on the right side of the line of least resistance. Do not fight the tape. Do not fight. Do not argue with weakness. Watch where price wants to go. Then ask whether volume confirms the intention. If it does, you have information. If it does not, you wait. Waiting is also a position. Many traders forget this. They believe they must trade every movement. They think every candle is an opportunity. But the market is not paying you for activity. It pays you for correct timing. And correct timing often requires silence. The third hidden indicator is the most important one. It is also the most ignored. Your own emotional reaction. This is the indicator most traders never put on the chart, but it controls every trade they take. Fear, greed, hope, anger, impatience, revenge, ego. These emotions create more losses than bad indicators ever could.